Welcome to the accounting class. In this session we shall take a look at how we set about the task of constructing a statement of cash flow. In the course of a financial year, a business may receive cash from various sources as a result of cash sales, from customers paying bills for previously supplied goods on credit, from insurance claims, from owners investing in the business, from taking out loans, and so on. A business will also be making payments for supplies, paying for utilities, purchasing new assets, repaying loans, and so on and so forth. So that during the year we can see cash flowing into and out of the business. This is what we shall term cash flow. To try and understand what is happening in terms of cash flow, we need to think about organizing all those transactions that involve cash. Fortunately, we are lucky, and this task is fairly simple. I know you have heard that one before. But it really is simple because there are only three groups. Cash transactions will belong to one of these groups: operating activity, investing activity, financing activity. So we shall make a start by thinking about what operating activities are. To operate a business, we need to do two things. A business cannot operate unless it receives revenue. In other words, it has to make sales of goods, services, raw materials, or a mix of any of these. In order to do this, it will incur certain expenses. So operating activities are concerned with those cash transactions that are concerned with revenues and expenses. The summary of all the activity for revenues and expenses will form the income statement. But here we are concerned with the cash transactions that relate to these. We are not concerned with goods supplied on credit where cash is yet to be received, nor are we concerned with services or supplies received that have not been paid for. What about investing activities? Investing in a business is about acquiring the assets that are needed to run the business. So if it is a haulage business, the investing would include the purchase of trucks. If it was a chain of stores, it would include the acquisition of land and the building of new stores. The investing activity will also include the sale of assets. Again, it is the activities that involve cash which we are interested in for cash flow. Now let's move to the last of our groups, the financing activities. Financing activities include those carried out by owners to put cash into the business or to withdraw cash from the business. When we group these and present the summary of cash flows in and cash flows out, then we have produced a cash flow statement. It is time to look at a few transactions and to group these. Nicole makes an investment of $50,000 in her business. Clearly, a financing activity. Nicole withdraws $600 for personal use. Again, a financing activity. Nicole purchases a delivery van for $16,500, paying cash for the van. She is adding an asset to the business. Here we are looking at an investing activity. Nicole has an old paint sprayer that was used in the business. She manages to sell this as a pre-owned sprayer and receives $350 in cash. She is disposing of an asset. This is also an investing activity. Nicole pays $400 in cash for electricity used. This represents an operating activity. Nicole receives a check for $12,000 having made sales of paints. Again, an operating activity. Nicole pays her van driver, Toya Montoya, $620 wages. Another operating activity, of course. Nicole supplies $12,400 of roof paint on account to Michelangelo, who informs her he's got some painting to do on the roof of a chapel. There has been no flow of cash. So this is not a part of the cash flow statement. Now we have a few transactions. So let's see if we can put these together. First, the cash flow from operating activities. There has been an inflow of $12,000 from paint sales, which yielded cash, and an outflow of $400 for electricity, together with an outflow of $620 for wages. Now the cash flow from investing activities. There has been an inflow of $350 from the sale of a paint sprayer and an outflow of $16,500 from the purchase of the delivery van. Lastly, the cash flows from financing activities. Nicole has an inflow of $50,000 from her investment and an outflow of $600 from a withdrawal. We are almost there. The final step is to put the three results from the three groups into a single statement. And here it is. This represents a very simple view of a cash flow statement. It shows the inflows and outflows of cash from each type of operating activity. A business will usually show rather more detail than this, and it will have many more transactions, of course, than we have used. However, the principle is there. The cash flow statement is going to show the inflows and outflows grouped by type of activity and showing as a result the net inflow or outflow of cash from the business. When you study managerial accounting, you will learn more of the importance of the cash flow statement. This ends our first session on the cash flow statement. Thank you for watching and for listening.